Subjective risks. Subjective risks is defined as certainty based on a person's mental condition or state of mind. For example, assume that an individual is drinking heavily in a bar and attempts to drive home after the bar closes. The driver may be uncertain whether he or she will arrive home safely without being arrested by the police for drunken driving. This mental uncertainty is called subjective risk. Now we discuss objective risk. Objective risk is defined as the relative variation of actual loss from expected loss. For example, assume that a fire insurer has 5,000 houses insured over a long period, and on an average 1% or 50 houses are destroyed by fire each year. However, it would be rare for exactly 50 houses to burn each year, and in some years as few as 45 houses may burn. Thus, there is a variation of 5 houses from the expected number of 50, or a variation of 10%. This relative variation of actual loss from expected loss is known as objective risk. Objective risk declines as the number of exposures increases. More specifically, objective risk varies inversely with the square root of the number of cases under observation. Now assume that 5 lakhs instead 5,000 houses are insured. The expected number of houses that will burn is now 5,000, but the variation of actual loss from expected loss is only 50. Objective risk is now 50 over 5,000 or 1%. Objective risk can be statistically measured by some measure of dispersion, such as the standard deviation or coefficient of variation. Since objective risk can be measured, it is an extremely useful concept for an insurance company or a corporate risk manager. As the number of exposure increases, the insurance company can predict its future loss experience more accurately because it can rely on the law of large numbers. The law of large numbers states that as the number of exposure units increase, the more closely will actual loss experience approach the probable loss experience. For example, as the number of homes under observation increases, the greater is the degree of accuracy in prediction, the proportion of homes that will burn. Static risk. Static risks are risks connected with losses caused by the irregular action of nature or by the mistakes and misdeeds of human beings. Static risks are same as pure risks and would, by definition, be present in an unchanging economy. Dynamic risk. Dynamic risks are risks associated with a changing economy. Important examples of dynamic risks include the changing tastes of consumers, technological change, new method of production, and investments in capital goods that are used to produce new and untried products. Static and dynamic risks have several important differences. Most static risks are pure risks, but dynamic risks are always speculative risks where both profit and loss are possible. Static risks would still be present in an unchanging economy, but dynamic risks are always associated with a changing economy. Dynamic risks usually affect more individuals and have a wider impact on society than do static risks. Dynamic risks may be beneficial to society, but static risks are always harmful.